So the jobs numbers just dropped and they caught a lot of people off guard. ADP came in negative midweek and the markets braced for bad news. But then the official report actually beat expectations. Unemployment ticked down, not up. Recession odds are falling and markets are loving it, rallying across the board. We're diving into what this means for the Fed, interest rates, and where things are going to go from here. Let's get to it. Starting off here, I have the ADP non-farm employment change, which came in at minus 33,000. This was on Wednesday, a little bit of a shocker. It was the first actual negative print that we've seen in years. Many were expecting the jobs numbers to come in pretty weak, and that's where a lot of the market anticipation was coming in. But Thursday, today, when we got that number, first off, the non-farm employment change was expected to have dropped from the previous month being 144,000. Was expected to come in at 111,000. In other words, the market was already pricing in low expectations and lowering the bar for where this number was going to come in. It came in at 147,000, stronger than the previous month, but not by much, pretty much in line. But the market was expecting the number to be negative, and it wasn't. The market is obviously taking this quite bullishly. The other thing that was a bit of a surprise was the unemployment rate, which was at 4.2%. It was expected to rise to 4.3% in that path of weakening that's been in place for the last year and a half. Yet it came in at 4.1%. Now, the 1 month is not enough to change a major trend. But the point is, July was not the month from which the jobs numbers broke. Last week, we talked about David Rosenberg's call that we might already be in a recession, and the data backs it up. Weak retail sales, slowing jobs, softening demand. Now, Polymarkets say there's less than a 20% chance of a recession in 2025. Sounds like a contradiction, but it's not really. David Rosenberg is looking at leading indicators while Polymarkets reflect market sentiment, a forward-looking bet on what might officially be declared later this year. So we could already be in a mild recession today, even if the markets are pricing in a soft landing tomorrow. Different tools, different timings, same economy, two ways to read it. The recession risks based on the poly markets dropped from about 25% down to 20%. Now, this number is going to continue to diminish because we're already in the second half of the year. When this number at the start of the year was much higher to like 50 to 60%, was when we obviously had very turbulent market conditions that looked very, very bearish at the time. This moment, this continues to plummet on the short term. While recession risks are there, at least what this is saying is the chances of it now being pushed to 2026 is much higher. Now, what does it mean for the Fed? Well, obviously, Powell is taking a lot of heat almost daily from Trump and his team, who want much lower rates. Has this changed anything? Well, first off, let's look at Fed funds futures. What we have here is basically the Fed funds coming in, or at least suggesting here that on July 30th, to a 95% probability, the Fed is going to keep rates unchanged. So what we have at the end of the year, going out to December, the belly of the probability distribution curve has 2 rate cuts coming in this year. That is pretty much in line as the way it was before today's jobs numbers. So right now, the highest probability is that we have 1 September and 1 December rate cut coming from Powell. So what about the markets? What impact has this had? Let's start off with the S&P 500, which is up close to 1%, up 55 points, which is just continuing to feed into quite an overbought state. Well, look, when everyone's expecting the number to come in weak and the number doesn't come in with market's expectation, there's going to be a positive reaction. So this, though, is now a very overbought state. We are over 300 300 S&P points above the 50-day moving average, which is an incredibly rare place to be. It doesn't happen very often that the market is so stretched away from its average. There will inevitably be some sort of mean reversion, but it's clearly not going to be driven by this jobs number, which is actually added fuel for the continuation. Should you buy? Probably not. The asymmetry of being long the market here is pretty bad. In other words, even just a 50% retracement, which is a very common thing to occur from a trading perspective, would have the market here have a risk of 100 to even 200 S&P point pullback. Yet really the upside of this market is probably 6,400 to 6,500, which is also about 100 to 150 S&P points upside. So there's about equal in terms of the payoff profile, and that's why it's not exciting to be chasing this market. There are definitely some exciting parts of the market. The sector rotation thing we talked about in our other video has certainly triggered a number of interesting opportunities in some of the sectors that have been left behind that are showing life. But just when you're buying the index itself, it probably isn't a tactical moment to be doing brand new buying. I want to touch on the 10-year treasury yield, and we had a little bit of an uptick as we went from about 4.25 to about 4.33 on the 10-year yield. A little bit of an uptick, but still the trend of the last month and a half downwards is still intact. We're still below a 50-day moving average, in a sense, just to depict the prevailing trend. Overall, we're going to get some valuable information. I think at this moment the yield here is not going to leave this trade range based upon this data. But what is interesting is when we look at SOFR futures. SOFR is the overnight lending rates, and in this case I want to look to December of 2026, looking at 18 months forward as to where interest rates are likely to be. Now we were just a week ago near 97, which means about a 3% interest rate at the end of 2026. That's pricing in 150 basis points or more of cuts. Now, in the last few days, including on reaction to this jobs numbers, we had almost 25 basis point peak to trough swing in this. So we're talking about fiddling around with one rate cut. Overall, what does this mean? The data basically is very much a status quo thing, where the market really didn't get any big surprise, and the path of interest rates and even the path of market has been more or less the same. This is not the data point that's going to move the markets big. Maybe it'll come a little bit later this month.